Welcome to the Life Success and Legacy Podcast. We're super excited. We are taking on a worthwhile endeavor at Life Success and Legacy. Our intention is to honor Nelson Nash, the man, as well as the infinite banking concept. We're going to create a series of resources, including podcasts and text, as a resource for others who want to truly understand with depth and clarity what Nelson shared in his book, Becoming Your Own Banker, as well as the many seminars and think tanks that we were fortunate to have attended during his life. So who is this intended audience? Well, we will use Nelson Nash's own words. It is written for the layman, not for financial advisors, but all life agents should be thoroughly knowledgeable of its content and practice. So whether you are an individual, part of a family, a business owner, or a life insurance agent, this is for you. So sit back, relax, and we will walk you through becoming your own banker step by step so you can reference the parts you want to revisit at your own pace. And we might have a little fun along the way. Hey, welcome back to the Life Success and Legacy Podcast. Chris Bay here with Mike Everett. Hey, Mike, how's it going?
Hey, I'm doing well.
You getting everything packed up for this family trip you got coming up?
We're getting focused. We're starting to get lists together. Now, do you think that I'm a list guy?
No, but I know who in your house would have a list.
Yeah. Well, I have a wife, a daughter, and a daughter-in-law that are all list people. So it absolutely works perfectly for me.
Yeah, you guys would probably get a nice easy rollout in the morning, maybe hit the road by 10 or 11, right?
No, we'll leave at 6 a.m. Let's go. I'm a goer.
I have traveled with Mike Everett many a times, and I'll just tell you, if he's in charge of making reservations, and he always is, it's going to be the earliest dang flight you can get.
I've gotten better, though. You got to admit, I've gotten better. We've left at like 9 or 10 o'clock in the last couple of flights. Well, this is pre-COVID, so
right.
I think I'm slightly getting better, just very, very slight.
Oh, okay. Hey, listeners, we are always having fun at Life Success and Legacy. We are in the chapter on page 23. We're in the chapter of creating your own banking system through dividend-paying life insurance, and we've broken this chapter up into several podcasts. But man, it's worth it because it is so full of really, really important nuggets.
Yeah.
We are picking up here on page 23, the second column, about halfway down, and it says, so far, this is a pretty simple stuff. Now for the complicated part. So now we're going to start getting into the details a little bit more, if we haven't already. The life insurance salesperson. Let me just preface this. If this is your first introduction to infinite banking, and you've been listening to a lot of financial advisors and radio shows and television shows and books and things, your cheese is about ready to get moved. Okay. We talk all the time about all the noise that's out there in the media and et cetera, and we develop these ruts in our brains.
Yeah.
It's our way of thinking based on what we listen to and what we read and all of that. Well, that is about ready to get challenged. Nelson really starts to lay this out as to how IBC works. So he says this all-American young man referred to earlier in the book, the one that's making around $28,500, and just as Mike had referenced, he uses just an average person who's not making very much money to show IBC can work for anybody.
That's right.
We just now are doing an application for one of our youngest owners of a policy yet. She's not even 17 yet. Now, we did have to tweak the ownership a little bit because she's not 18 yet, but essentially she's going to own this policy. Her mom's helping her out until she's of age. But Nelson uses this all-American. He's making $28,500 after taxes, and he's 29 years old. and he urges him to consider how much the world is going to miss you in the case of your untimely death. So what we're going to talk about now is human life value, and I'll give a little bit of information, some context, and then Michael will fill in the dots here for us. So if we're a single income family, which we are, and I make X amount of money each year, and I'm projected to work for a number of years, that amount of money that I make each year multiplied out by the number of years that I'm working, that is my human life value. So in essence, what I am, and this is kind of crude, but in essence, I am a money making machine for my family.
Yep.
I am a machine that makes money for my family, and I'm projected to make X amount of money if things, continue as is. The amount of money I make each year multiplied by the number of years that I'm going to be working. Okay.
And that's
So
assuming if you live that long.
right. And what life insurance essentially is doing is it is my wife insuring that money making machine. That's what it is. Because if if I fall off the earth in 5-10 years, her money making machine is gone. So what life insurance is doing is protecting that machine that earns money for our family. So that's a very simplistic way to explain this. But the term is human life value. So Mike, can you unpack that human life value a little bit for our listeners?
Well, I'm just going to literally. So the human life value is we try to figure out how much per year on an average and multiplied by the number of years that somebody's going to work. And then Nelson says, assuming that they're going to live this long. So they're figuring not just what they're making right now, but they're taking into consideration raises and bonuses and all of this stuff. And the reason why they do that is because they want to figure out approximately what your life is worth or the value of your life, so that if you do graduate a little bit early, if you die a little bit early, then those dollars will be paid to your beneficiaries through the life insurance policy. It is really, it's what we call a gap filler. It's just filling a gap in case things don't go as planned. I don't know if that helped.
Yeah,
but it's
absolutely.
pretty simple. Yeah.
So then the example Nelson's talking about, he's using an agent who's talking to this young man, so a life insurance agent, right?
Yeah.
And then he says, so if they figure out how much this human life value is going to be for this young man, and it was a machine, wouldn't you insure that machine? Yeah, you want to talk about that part?
Well, I just think it's so funny because, we always ask the question to people, what's more important to you right now, cash or life insurance? And 99.9% of the people say cash. Well, and then I turn around and I ask, what about for the guy that's getting ready to turn 65? Is it cash or life insurance for me? And everybody almost unequivocally says, well, life insurance. And I go, well, do I look like I'm getting ready to die? And they say, well, no. And I said, so why wouldn't it be cash for me? So basically, I'm a money machine, you're a money machine. And so people who are out in the working world are just nothing more than machines making money. So if you end up having a machine at your business that is worth X amount of dollars, would you insure that machine? And the answer is 100% yes. So that's when Nelson turns this thing on its ear and says, well, you want to insure that machine. So that's the way we turn around and figure that. Now, I am talking specifically about life insurance sales agents.
Yes.
We are not life insurance sales agents. Are we life insurance guys? You better believe it. But once again, we are infinite banking coaches and teachers and educators. Our job is to help you think through on what this truly looks like for you. But if you go back to the life insurance sales agents, then they turn around and say, well, you should insure that a machine, you, for X number of dollars. And then what they do is they turn around and they figure out exactly what kind of life insurance policy they need in order to insure that machine. It's kind of simple.
So with the calculations that Nelson walks through, and we won't go through all the calculations, but they figure out that, you know, his human life value is X amount. He says, so if we were to have to buy a machine that would produce that income to your family, we would have to pay about $400,000 cash for the machine now. That's how valuable you are to them and your charities. Mr. Doe, this is the young All-American, if you owned such a machine and it was subject to sudden loss of some kind, would you insure it? And Mr. Doe says, of course,
oh my,
well, by all means. And the agent asks, how much would you insure it for? Well, by $400,000, of course. To which the agent responds, now that we have that established, let me show you how little you will have to pay my company to satisfy that need. It makes me think of Needle-Nosed Ned, the insurance salesman on Groundhog Day, that movie. Yeah. Our listeners, if you haven't ever checked that out, pull up a YouTube on Needle-Nosed Ned from Groundhog Day with Bill Murray. That scene is just hilarious. All right. So now, Mike, I know this is right in your wheelhouse, whenever Nelson starts a sentence with my word with exclamation points, what he's doing now is this is the shift, right? This is where we're shifting your way of thinking. And so kind of walk us through that shift that Nelson's starting to unpack for us.
Well, when you start to look at all the different things that this young man has financed, whether it's a house or cars or credit cards or student loans, Nelson, he's done so many calculations, but he's paying approximately 35% of every dollar after tax income to interest alone. And it's obvious, Nelson says in his book, that his need for finance is much greater than his need for life insurance protection. And if you solve this need through dividend paying whole life insurance, he would automatically have more life insurance and recover 100% of the interest that he's now paying to somebody else. So part of what we've got to do is that shift that you're talking about, the brain, those ruts that we have in our brain, we've got to educate people about that interest that they're already sending out the door to somebody else. And the mental block, the mental just things that we have to overcome in helping people see beyond what's going on in their lives, it is unbelievable. But yet, this is what the financial geniuses have done to us. It's in business schools, it's in finance class, it's in the accounting classes, it's our CPAs. They've all made our path to run on so skinny that it's difficult for us to get outside that area and think differently about a place to store money and how we would learn how to finance stuff and how to create a system, how to create a bank like the ones that we already know about. And then on top of that, utilizing dividend paying whole life insurance as the financial vehicle to make all of that happen. It's overwhelming.
I just think about myself, my own family, and just an average family, you know, and you're thinking about, okay, I've got debt that I've got to finance. I got to make sure that I have life insurance in case something happens for me to protect my family, right?
Yeah.
And then I've got to be thinking ahead to some kind of retirement or money so that I don't become dependent on somebody else in the future, right? And so I've got this $1 that I'm trying to decide where am I going to put that dollar, and so I'm putting as much towards debt as I can, and I'm putting, you know, I'm putting 3% or 5% or whatever towards my retirement, and hoping that that works out. And then I'm also maybe doing term life insurance just to make sure that I've got my family covered during our child rearing years for sure. And what Nelson's saying is if we look at that and we look at, first of all, we've got 30 to 40% of our money going to taxes up front. Then we've got another 30 to 40% going to the interest on our debt. And he's like, we're missing the whole game here. If we would simply take that money that we're putting towards term life insurance and investments and all those kinds of things, and instead run that money through whole life insurance, the question isn't how much are you paying, it's that we're not paying enough.
That's
We
right.
want to look at those premiums as deposits and get as much money into those as we can, because then we can take care of our life insurance, we can finance our debt, and we can have money available for us later on in life so that we're not dependent on other people.
Just using
It's a huge shift of thinking.
Yeah, just using the percentages that you just gave, and I just tabulated this real quick. We have 80 to 85% going for interest, taxes, just all the things that we're financing. And that means that we're having to live on anywhere from 15 to 20% after everything's all said and done. And we wonder why we can't get ahead.
Yeah.
It's a mess.
It is, and we will jump into even deeper, some of these concepts and the wind current, shifting the wind current, and all that. But what we just described, that the amount of money that's going to taxes and the amount of money that's going to interest on debt, our clients who utilize infinite banking, they're able to eliminate the money going to the debt part, the interest, and in some cases reduce and eliminate most of their taxes because of how they're using their banking system to do real estate and other things.
Yep.
So that number that is flowing out the door, out the window, that we don't see it ever again is huge.
It's a big number.
And yet it can be solved by creating your own banking system using a specially designed whole life insurance policy.
Yep.
All right, so middle of that page, he says, so the young man puts $50 per month into life insurance premiums and feels that he is insurance poor, right? He is worth more dead than alive. Then he goes down to a dealer and buys an automobile, paying for it with a loan from a bank or finance company. Remember, there's only one pool of money out there in the world. The fact that any number of organizations or individuals are managing a portion of the pool is incidental, but it can be even more specific when it comes to automobile loans. Okay, do you want to talk about that? What people are doing when they take automobile loans from that pool of money?
Well, I'm gonna back up a second, and we're going to talk about insurance poor. So, we have people that are spending money on, I don't care if it's life insurance, I don't care if it's home insurance, renter's insurance, automobile insurance, and we feel like we're poor, but yet we have so many people that go down to the automobile company and they finance a vehicle. And in this particular example, remember, Nelson's book was written in 2000. This particular gentleman's spending $260 a month for a automobile loan. Well, let's run to 2020 when we're now car loans are anywhere from $500 to $1,000. I'm going to use that as an example, depending on the kind of vehicle that you get. And people don't think anything about spending all that money, but yet when they look at what they're spending on whatever their insurance is, they get kind of freaked out. They get kind of disillusioned that they're spending too much money on insurance. So what Nelson does is he turns around and uses this 29-year-old gentleman who's making $28,000 a year, and he uses this example that if we turned around and changed the way he thought about this, so the $260 a month, what he should do is he should take that $50 a month that he's actually spending on the life insurance, add it to the payment that he is making towards his car loan, and send $310 to a pool. Now, keep in mind, if you start to think about Nelson's basic principles, think long term, don't be afraid to capitalize or capitalize your system generously. What we're going to have to do is we're going to have to take anywhere from, I'm just going to use 5 to 8 years, 5 to 7 years, and create a pool to where he can then begin to learn how to finance his own vehicles himself. Does it take time? You better believe it does. But the financial payoff that would be down the road for this just one individual who doesn't make a whole lot of money a year will be significant. So it's a matter of helping people think differently. So the insurance agent really needs to make him vividly aware that he must pay the loan back at an interest rate. So as he's creating this system, what we're going to do is, and we talked about this in one of our earlier podcasts, is we're going to have this pool that we're going to have access to. We're the owner of the contract. It is a unilateral contract between us and the company, and we are the owner, and we have first rights of that money. So if we create this larger pool, then we have access to that equity to be able to go out, take the equity, and pay cash for that car, and then learn how to finance that. That is part of what you get with our Life Success and Legacy team, is an ongoing coaching, but helping people think through why we do what we do in order to help you create a system that will never, ever go away. And it just so happens that we're utilizing a dividend paying whole life insurance policy. It is just unbelievable.
Just to give a little anecdote in the middle of this, the example Nelson talks about obviously is capitalizing a policy for a period of 4 years or whatever, so that you can fully take a loan out and pay cash for the vehicle entirely. Yes, that's ideal. But we have clients all the time where they are maybe first starting out their policies and they haven't got them capitalized for 4 years and they've got a car loan. Well, we just coach them in, they're going to use their system to pay for part of the car with cash, but they're going to finance part of it with a bank.
That's right.
They're still going to pay the thing off in a year or two and get it all paid off. You don't have to wait until you have the full amount to pay full cash for the car. And again, that's where the coaching comes in, is we help people think about their different options. And again, we don't tell people what to do with their money. We just educate and we show what their possibilities are, and then they decide what's going to work best for them. All right. So now Nelson kind of plays a little bit of devil's advocate. He says, well, now wait a second. What if the policyholder objects and says, well, it's my own money. I'm not going to pay any interest at all. Or maybe I'm only going to pay 2.9%, as I see in television commercials. So a little lesson there. Mike, you want to talk about what Nelson's trying to get across there? He even references the guys in Midland, Texas again.
I'm telling you, then you got to take them back and think about some of the earlier chapters that we dealt with, whether it be the grocery store, because what we're trying to do is we're trying to help people understand this is a business, and what we're wanting to do is we're wanting to pay retail for the dollars that or the inventory, and the inventory just happens to be our dollars. And if they still don't get it from the grocery store, we're going to take them to the First National Bank of Midland, Texas, and the failure that the stockholders of the particular bank, everything went downhill. They weren't
paying on their loans.
Yeah.
It goes back to Nelson's principles. Don't steal from your system, right?
I'm telling you.
System. You got to think long term, and don't steal from your system. And in both cases, whether it's the grocery store who's paying wholesale or taking their can of peas out the back, or the bankers in Midland, Texas who weren't paying on their loans, in either case, you're stealing from your system, and the system will break down if you do that. Yeah, Nelson, he says, if you're working with somebody and you've gone back and walked through those, he says they're either not teachable and or they are a thief. Neither of these characters is a desirable business associate.
It's a little rough, but it's a reality.
Well, that's how Nelson, he didn't pull any punches, man. He just shot
No, he did
straight.
not. No, he did not.
Okay. Um, so the above example of car financing, the capitalization needs to be somewhat greater than just 4 years. Many college business professors estimate that corporations expect it to take at least 7 years to get back a profit on a new investment. This is an understatement in certain undertakings. So why not capitalize each policy purchased for at least 7 years to the point where dividends will pay all the remaining premiums on the policy? Now, we're going to be looking at illustrations in the book as we get into this in future chapters.
Yep.
And Nelson just references there, what about if you got to the place where you capitalize where the dividends could actually pay for the premiums? Mike Everett, would you ever stop making premium deposits?
Never.
Why?
Because of the policy, the way it's engineered. So when I'll use $1, I'm just going to use $1. So let's pretend that you and I are going to go into business together, because he uses a lot of business analogies inside this thing.
Mm-hmm.
So we're going to put $1 in our business every year. So the first year we put $1 in, and if we showed you how to actually access 50 to 60% of that dollar in the first year, we did pretty well in our business. The second year, we put $1 in our business, we access around 70%. The third year, we put $1 in, we access around 90%. And the fourth year, we put $1 in, and we access the full dollar. Now, if that were a true business model, how many times would you want to be in business like that? Every single time.
Yeah.
That is exactly the way we design or reallocate the dollars in premiums. So if it works with $1, would it work with $100? It would. Would it work with $10,000? It would. Would it work with $100,000? It works exactly the same. But it just so happens that we're purchasing a life insurance policy. So what we're trying to do is we're trying to get people to understand that there is a certain capitalization that needs to take place. So the bottom line is, if I got 4 years down the road and I knew I was going to put $1 in my particular business or in life insurance premiums, and it grew by more than $1, would I ever want that to stop?
No. No.
So we help people understand that particular principle. Obviously, with the capitalization of those 7 or 4 years, he uses an example later on in the book in the equipment financing, but we help people understand why the capitalization needs to happen. And then we help them understand why they would not just make the minimum payment, but add to that minimum payment with economic value added. So they would create additional capital, a larger pool of money that they and their families would have access to. It is really that simple.
There's a lot of people, though, that their concern is when they look at the premiums that they're putting in, and say they're in their working years and they're putting money in and they're making money and it's all working great. But their fear is looking ahead to, okay, what if I want to retire sometime in the future? My income decreases. What if I do a change of career and I'm not making as much money? How am I going to support these big premiums 10, 15, 20 years down the road? What do you say to someone like that?
Well, part of them is helping them to think through. Number one, so many of our clients come to us and they have just a ton of debt: house, cars, credit cards, student loans, and the whole shooting match. So if we can somehow get rid of that debt and then we refunnel or reallocate those dollars back into their system, then what we're doing is we're creating larger dollars available down the road. But yet, if the premiums end up being too much, there are all kinds of options to be able to help them think through this. And once you get down the road 15, 20, 25 years, when you're paying premiums, and I'm going to use an example, if you're paying $1 in there and it's growing by $4 or $5, how hard is it going to be to find $1?
Right.
It's going to be unbelievably easy. And if they're debt free, there's all kinds of options to be able to help them think through how they would come up with that dollar. The premiums are inconsequential down the road. They really truly are.
Yeah, we have clients who, most of our clients are completely free of outside debt in 3 to 8 years.
Yep.
Sometimes sooner. And so if you have no outside debt, your home is paid for, you have no other debt, you have all that equity. We have folks who they have a home equity line of credit that they use one time a year. They borrow against their equity, they pay their premium. The money that becomes available is more than what they paid in premium. So they turn around and pay off the home equity line of credit all within 30 days and made money on it and kept their life insurance in place and the whole thing. So there's so many creative ways to do that.
It's unbelievable.
That's not an issue. And even then, the way we design the policies, a large percentage of it is called a flexible paid up addition rider.
Yep.
Right? The key word in that is flexible.
Flexible. Yeah.
A lot of times we drop that down to the minimum $100 a year, and so your premium has decreased by that point. So there's tons of possibilities here. I do want to use this as an opportunity, though. I don't know that Nelson does a clear job of explaining his mindset, and he's very clearly thinking about his audience who most people don't want to take loans and they don't want to pay premiums. And so many of the examples in the book, he shows either decreasing the premiums. For example, here he says, why not capitalize each policy purchase for at least 7 years to the point where dividends will pay all the remaining premiums on the policy? There's a mindset that he's writing to when he talks about stopping paying premiums.
Yep.
And that same mindset is about not taking loans against policies. Can you kind of help, because you know Nelson and you'd heard him speak so many times, can you help people understand why he's writing this? Because this is not how he would teach it.
No, it's not.
People, but he's writing to a specific audience.
Well, it really has to do with the way we were trained in business schools and finance. Even the financial gurus out there are teaching us to pay as little as we can, and then at one point in time we can eventually stop paying on something. And Nelson is just speaking to that particular mindset. So part of the dilemma that we have is to help them change their thinking. And we've said this in an earlier podcast. Nelson always said it's a matter of how you think. And even in this particular podcast, we have these ruts in our brains that we truly cannot overcome certain thought processes because that's the way we all got taught. So part of what we've got to make sure that we're doing is we're teaching people to actually utilize and maximize their system to the utmost. And if we get down the road and we pay $1 in premiums and it grows by $3 or $4, do we want to use the dividends to reduce the premiums? We do not. So part of what we've got to do is we've got to help them understand the inner workings of the policy. We've got to help them understand their premium deposits. We've got to help them understand why we take policy loans to reduce outside debt, to create a situation to where the change in the payments that we would make would come to us instead of to finance companies or outside financing. It's unbelievable. And there's so many things that are going on in my head, but yet part of what we've got to do is we have to give people this in bite-sized pieces in order to get them to understand. We can't give them the whole steak. They've got to cut it, chew it, and figure it out, because we want to help them understand how their system can truly benefit them and their families.
We will come back to this point when we start looking at some of the illustrations later in the book, because oftentimes people go, wow, I want that policy where you only pay premiums for 4 years, right? Well, our way of thinking, the way we've been taught to think is, yes, we look at those premiums as a bill, but if you look at that premium as a deposit, you would never want to stop making those premiums. So then why does Nelson show an example in the equipment financing where he stops making premium deposits in the 4th year? So we'll come back to those and why Nelson did it that way in the book. That was good, Mike. Thank you for taking a moment to kind of give people some insight as to how Nelson was trying to write to his audience. Okay, now he does reference here, I'm at the top of 25, he says, you must build it to the point where you accommodate the needs of others in order to prosper. That he's referencing the grocery store, and then he's making the analogy from grocery store and making that link to banking. So he's saying what? We should build this thing so that not only can we take care of our own financial needs, but also other people's needs. You want to share about that? What he's talking about?
Basically, if you're going to build a system, an infinite banking concept system, then chances are you're going to need a place for some additional capital, especially when you reduce or eliminate your personal debt. Then most of us have families. So we have children, we have grandchildren. And the way I get people to think through this is, think of some things that you have done in your life. Did you buy a car? Yeah. Did you go to college? Yeah. Did you get married? Yeah. Did you buy a house? Yeah. Well, after all of those things have happened and you start to have children, are they going to do those things? They're going to also do those things. So because of where most of us have come from, we've come to a place where we've learned about infinite banking. But when we came to the table, we had credit card debt, we had car debt, we had mortgage debt, some had college debt, student loans. And if we're able to get rid of those things, then mom and dad and or grandma and grandpa can then become the financing arm for those particular financing issues for our children and our grandchildren. So what you're doing is you have your family circle. How big do you want your family circle? Well, I want mine to be really big. So as our kids and grandkids get older, can we finance their cars? Can we finance their mortgages? And really, those payments then come back into the system to build greater wealth, greater equity, and yet still build a greater pool of money that then you can access for future purchases. It's really so simple, but yet so difficult for people to overcome because that's not the way we got taught.
Yeah, and we'll touch more on family banking and creating a family system multiple times throughout the book, I'm sure. It's one of my favorite topics to talk about. We have several clients who have really created amazing family banking systems where they are not allowing any of their dollars to slip outside their family circle. They're simply recycling those monies. So going back to one of the things we were talking about earlier, you know, people being concerned about their premiums in the future, not being able to pay them. Well, when you have a family banking system, the loan payments that the younger generation is paying on the borrowed money they've taken from the family system, those payments are paying the premiums.
You don't have to come up with money out of your pocket. You're letting your kids finance the premiums.
Yeah,
it's unbelievable.
And we've got a podcast. Maybe Michael Crawford can note this in the comments with this podcast. But we've got a podcast that talks about family banking and some examples with that. Okay, I'm going to keep us moving here. Gosh, we get excited and we just want to talk about this stuff. Let's wrap up this chapter here. Nelson is talking about a system of policies. Okay, he says, why would you not expand your own potential by buying all the life insurance on yourself that the companies will issue, and then on all the persons in which you have an insurable interest? So Nelson at one point owned 49 life insurance policies. Okay, now not all of those insured his life, right? He insured family members, children, grandchildren, great-grandchildren, business owners, anybody that he had an insurable interest.
Yep.
Can you very quickly describe for people what is an insurable interest?
Well, an insurable interest is basically, and I'll just use you and I, for example, we're business partners. If something happened to me, what would happen to where we go as a business? It would probably take a couple of steps back. So you have a policy on me. I also have a policy on you because we have insurable interest in each other. Do our spouses have insurable interest in us, or do we have an insurable interest in them? Absolutely. So it has to do with the fact that if someone was removed off of this earth through death or whatever, would your financial wherewithal be challenged? And the answer is yes. And
Yeah.
so that would create this insurable interest that we're talking about.
So Nelson would buy policies on people he went into business with,
Yep.
or if he loaned money to somebody, he right away would get a policy on them. Because
Yep.
if something happened to them, how's he going to get his money back? Right?
That's right.
So
That's
that's
exactly right.
insurable interest. So we help clients think through the people in their life that they have insurable interest. Now, in most cases, you're starting with yourself and your immediate family.
Yep.
But in some cases, like Mike and I, we have insurable interest in ourselves. We have an insurable interest in our team members, Mike Crawford and Shelley Forbes. And, you know, those are people that we have an insurable interest. And so those are people that we can get policies on. And then we're the owners of them, so we can utilize those for banking purposes, whether that's on a personal level or inside the business. We
That's
can do
correct.
that. And again, we teach people about that. So now Nelson is talking about at the very end of this chapter, he says it'll take the average person at least 20 to 25 years to build a banking system through life insurance to accommodate all of his own needs for finance, his autos, his house, etc. But once the system is established, it can be passed on to future generations as long as they can be taught how the system works and suppress their baser instincts to go out the back door of the grocery store, or in a word that is more descriptive, to steal.
Steal.
The biggest challenge is not being an honest banker and not paying back your
Yep.
loans. Yep. When people say, what is the risk with infinite banking? We always say the risk is the
You.
policy owner.
That's
You.
it. That's it.
Are you going to be an honest banker, and are you going to make payments back to your system? Now, for most of us, it's going to take a while to get to the place where we can finance everything in our life,
Yep.
right?
Yep.
But what happens, Mike Everett? Let's just use your example. What happens to the system if you've done an effective job of educating your family and future generations about how IBC works? What happens to the system once you, as the oldest male, passes away?
Truly, the system will become self-sustaining, because chances are, in a number of the policies, you've taken policy loans, you've financed life, whether it be house, cars, credit cards, whatever. And if there's a large policy loan out against that policy and I die, then chances are the money that will flood load back towards the system will automatically pay off all of the policy loans, plus there will be an excess of dollars available for either additional policies or additional financing. It truly will become self-sustaining. This is the number one principle: think long term. And when I started my plan back 15 years ago, I literally thought in my brain, I'm doing this for my kids and my grandkids that I did not have at the time. And then all of a sudden, because of the way we started to utilize our system and the fact that we had available dollars to utilize out of our own infinite banking system, I finally realized, and this was probably 3 to 5 years into my system, I go, oh my gosh, this is not just for my kids and my grandkids. This is for me and Linda right now. So we've been able to utilize the system and had no idea how quickly this thing would grow once we started to control our own wind current. And we haven't even gotten into that chapter yet.
Mhm. Mhm. This is
Oh,
one of the things that gets me super excited, just because of my background as an educator. The education piece of this with future generations to me is so critical. It
yep,
is the gift is not the death benefit that they're going to get a bunch of money. It is the education they're going to get of what to do with that money when it happens. That is
that's
really
correct.
the most important piece for us. So, all right. Well, that was a packed full chapter that we will be wrapping up in our next podcast. We'll review some of the basic understandings of that chapter. We'll hit on a review of part 1, and then we'll be digging into part 2, which includes the human problems and Parkinson's law and Willie Sutton's law and some of those fun things to talk about. So to our listeners, thanks for joining us. We're really honored that you would spend time listening to this podcast talking about the treasure that Nelson left us with
Mm.
becoming your own banker. That is truly our intent, is to honor the man and the work that he did over his lifetime. So we hope that you find this information helpful. You can get a copy of Becoming Your Own Banker, BYOB, at lifesuccesslegacy.com, or the case for IBC, also available. And then we have also got our other podcast that we've referenced that goes a little bit deeper into some of these topics, as well as interviews with some of our clients, and you can hear their personal stories and how they've used IBC in their lives. So thanks again for joining us, and we'll catch you next time on the Life Success Legacy Podcast.